Well, thank you for joining us this evening. This is part of a series of aligning your money with your values. But this is a very special presentation this evening in that we have our friends from LONGWAVE Financial. I've been collaborating with LONGWAVE Financial now for going on 3 years. We've done some workshops, special workshops. One in particular was working with faith-based groups to help them understand how they could divest their endowments. But the team there at LONGWAVE has been very active in the climate movement. They follow the newsletters from Third Act, and I think they can give us some good insight to how to align our investments with our values. So Nathan, let's take a look at the next slide here so people can see who we are. So again, this is presented by Third Act Upstate New York. And LONGWAVE Financial is our special guest and presenter this evening. I am Michael Richardson, Third Act Upstate New York co-facilitator. And we have with us Nathan Munitz, Brandon Wester, and Lane Springer, who's going to give the presentations. Nathan, I like that poster that you have to the side. The moral arc won't bend itself. I understand that's from the hands-off rally that you went to recently, right?
That's right, in Hastings on Hudson, town
like
over from where I live. There were a lot of great posters there, Michael. You'd have been proud.
The moral arc won't bend itself. You got that right. So let's take a look at this next slide. And some of you on this webinar this evening, I recognize many of the names who've been participating in some of the workshops we've been doing for the past 4 years, whether it pertains to banking or insurance or investments. And what it says up there at the top, your money is your power. Those of you that are third actors, you might recall that when Bill McKibben and Vanessa Arcara put Third Act together, that they recognized that elders really had two powers. One is our high propensity to vote. And of course, that's so that we can uplift democracy. And the other one, to put it simply, is we got all the money. And so I think we need to take a good look at what this is all about, that our vote, and of course, we're talking there about our vote in democracy, but here we're talking about our money. And we'll get to this, how we can actually vote with our money as well. So those of you that have been on these workshops about banking, we talk about how this is our money, our deposits. And we put our deposits into banks. And once we do that, we really have no say what happens to that money, right? The banks take it and they use our money to make loans and to underwrite corporate debt, bonds, notes, in such a way that we have no control over what they do. And we talk about in our workshops how we can leave the big Wall Street banks and go to community banks in such a way to see our money going from not only harm to no harm, but actually doing good in our community. And then when it comes to insurance, we learn about how our premiums are being used by these big insurance companies in ways that here again, we have no control over. They get to take those premiums while they're sitting there waiting to pay claims, and they make loans, they underwrite and other type of debt, and they actually take some of that and invest it in things that we have no idea what they're doing, but quite often it doesn't align with our values. But here when we talk about investments, it's very different. This again, like banks, this is our money, but we say exactly where it goes. And there's a lot of finger pointing that goes on about the bad guys doing this and those guys doing that, and we want them to divest from here and there. But remember, we really should be looking in the mirror because we are the ones that are telling them where to put our money. And so if we want to see our money move in such a way that it is doing something that aligns with our values, we need to take proactive steps. The responsibility is on us. So this evening, LONGWAVE is going to help us understand what's going on with our money, and how we might move it in such a way that our investments align with our values. So Nathan, why don't you take it from here?
Thank you, Michael. Thank you so much. So, well, first of all, good evening, everyone. Hope everyone's having a lovely Earth Day today. It's good to see all these faces and some familiar faces. And I hope the weather was grand today out where you were. Certainly beautiful day here in the Northeast. Um, so where I want to start, thank you, Michael, for teeing this up and inviting us to Third Act and to present today. Um, just by way of introduction to LONGWAVE and myself. I've been a financial advisor for 22 years, and over the last number of years have been really helping clients align their values with their money, with their investments. But really what we've made our mission now is education. We think it's really, really important that the world knows that there is this path for us of aligning our money with our values. I think most people, just like 30 years ago, people didn't know that there was this way of eating called organic eating. And then people came to realize there's this much healthier way of approaching food. I think that most people, the general public, doesn't even know that there's this way to align your investments with your values. Layered on top of that, if people are aware that there's a way that you can do this, there's a lot of misconceptions that potentially you might have to give up returns or skepticism if this is something that could be done authentically or not. And so a big part of what we try to do through these kinds of talks is just educate. And today is really kind of 101 when it comes to values investing. Just where do we start? What are the first few pages of this book, this investment journey? And where I'd like to start is really just to talk about the path that anyone would have on an investment journey. And it really starts with a couple of layers. The first layer is the intermediary layer, which is if you're looking to invest, you're generally doing that with a bank or a brokerage or your 401k, or if you're a public employee, your 403b. And usually that is managed by, again, a bank, like, let's say, Fidelity or JP Morgan, and potentially if you have a 401k or 403b, maybe Vanguard or TIAA-CREF. And so they are managing, they're the intermediary, and they certainly also get fees for doing this. And again, we tend to try to think about where are those fees going that we're providing to these intermediaries. So that's the top layer. And the layer below that is the investment vehicles that these financial institutions create. So if you open up your 401k or 403b or IRA, you'll see that there's funds in there. There's not generally individual stocks and bonds, there's funds. And those funds, again, have names like BlackRock and Vanguard and Fidelity and so forth. And those funds are created to help investors diversify their investments into U.S. companies and large companies, small companies, international, and so forth. And generally, those traditional funds take a very, very wide, they just throw out their arms and they say, we're just going to invest in as much as we can to have the maximum diversification as possible. And so if you're investing in everything, then if you take the time to look into what funds you own are actually investing in, all funds have ticker symbols. You can go online and just plug in that ticker symbol and it'll take you to Morningstar or other resource, and it'll tell you what holdings you own in your funds. And so if you're taking a traditional approach to the funds that you own, you're going to open it up and you're going to see that you have Exxon in there and Lockheed Martin. The Geo Group is one of the largest private prison companies in the United States. So they're a company that derives profit from incarceration. And so you have to question what are their values? What are their business goals? And so you may not want to, as Michael said, you may not want to give your capital to these companies that they will take and reinvest in oil fields or factories, or anything else that they're engaged in. So number one is looking into the investments that you already own with the intermediaries that you're with. So let's say you turn to the next page of this investing book and you say, okay, I want to keep going in this story. This is a good story. I'm curious. What's the next step? I want to think about aligning my investments with my values. What's next? Well, right away, there's a little bit of confusion, and I think anybody that has tried to invest on their own, they've run into quite a bit of confusion, just with any kind of investments. But even when it comes to values-based investing, in a sense, there might be even more confusion because you actually don't know if what the investment is aligning your values with your money in an authentic way. One of the terms that we use is greenwashing. And there's all kinds of washing, as we know. But for our purposes, greenwashing is essentially when an investment company says, hey, it seems like people are really interested in aligning their values with their money. Why don't we just slap a label on one of our funds and say it's green or it's sustainable? It's really just a marketing gimmick. And we see this in lots of different parts in our life. And it just means that we really just need to go deeper. A true story in greenwashing land is a number of years ago, Goldman Sachs saw that people were interested in values investing, and they looked at their funds. They had several hundred different funds, and they said, hey, we have this one fund. It doesn't have a lot of oil and gas in it. It's mostly technology. Let's just call it a sustainability fund, and maybe we'll get some investors interested. And that worked for a little while, and then this SEC came in and said, wait a minute, you're really not doing anything here. You have no systems, you have no processes. It's just a gimmick. They sued Goldman Sachs. Goldman Sachs paid a $4.5 million fine. And rather than putting systems in place to make their fund more sustainable, to have specific goals for that fund and screening criteria, they said, forget it. We're just going to go back to the original name that we had in that fund. So that's something that's going on in the investment industry, not surprisingly. Another barrier as a sort of going into the forest of sustainable investing is some of the intermediaries that you're going to encounter are financial advisors. And financial advisors are, to some degree, can be a gatekeeper to investing. And as a group, financial advisors tend to be a little bit more on the conservative side. There was a survey in 2023. Who would you like to see elected? This survey went out to financial advisors. 60% of financial advisors wanted to see a Republican elected. 25% of financial advisors wanted to see a Democrat elected. So right out of the gate, if you're going to your average financial advisor down the street, they're going to already have, just like we have a certain viewpoint and a certain positioning, they're also going to have their own viewpoint and their own biases. And so is this something that they're going to take seriously? And even if they do take it seriously, do they have the expertise and the interest to actually do this well? And the final thing that I would point out, another barrier, is simply all the labels. Just like there's different kinds of dogs, you have Chihuahuas and you have Great Danes and you have Saint Bernards. It's sort of similar in the world of values-based investing. You have impact investing and green investing and socially responsible investing. And all these things actually mean different things. And so if you're just if you just turn the page to, okay, I want to do this, but what do all these labels mean? A great example of that is socially responsible investing, which was a thing that kind of a catch-all term that originated in the 70s. Well, of late, socially responsible investing may or may not include or exclude stem cell research. Somebody that says, well, I'm interested in socially responsible investing, they may have an investment, a fund that excludes research into stem cells. Or conversely, you might have another socially responsible fund that is overweighting to stem cell research. It's hard to know unless you really dig into that. And so right out of the gate, you have to try to navigate what is the label actually telling me? And sometimes it's not even the label can be inaccurate. All right, so we've decided we are interested in values-based investing. We know it's confusing. So where do we go from here? We're in the forest. We have 3 different paths. How do we lift this veil of confusion? And we've narrowed it down to 3 different paths just to make it simple and easy to think about. What kind of values investor am I? What's important to me when I think about values investing? And from our perspective, and this is where a little bit of interactivity comes in, here's what I'd like everybody on the call to think about for a second about yourself. I'm going to throw out 3 phrases and think about which of those rings most true to you. Number 1 is, I want to avoid investing in companies that go against my beliefs and my values. I simply just don't want to own these companies. I don't want to connect with these companies. I don't want to engage with these companies. I just don't want to own them. And that approach is generally referred to as divestment. This approach has its pros and cons, but it's just one path that we can take in our journey. The next phrase that I would give you, and again, think about what this means to you, is I want to seek out investments that can benefit from future environmental and social trends. So a great example is, I think the future of energy production is going to be renewables. Is that something that we can focus on in our portfolio? Or vice versa. I think, we also don't want to own oil and gas companies because maybe in 20, 30 years, they're going to go the way of the dodo. How do we get ahead of that? So that's the second path that we can take. And finally, the third path is what we call impact. I want my investments to have an altruistic purpose. And I understand that that's a dual mandate where potentially I may be giving up some returns or maybe taking on some risks in my investments to have this impact, this social or environmental impact that I'm looking for. So take 1 second to think about which of these 3 phrases, these terms, are the most resonant to you. And now we're going to get into actually what those phrases mean specifically when you are constructing an investment mix for yourself. So I'm going to hand it over to my colleague, Brandon Wester, who's our Chief Investment Officer, and he really gets into the weeds and the science of actually selecting funds for building this out. So Brandon, please take it away.
Yeah, I'm gonna kind of start with the first path Nathan talked about, because it's usually the way most people think about sustainable investing, values-based investing. Most people think of it, I just don't want to own these companies. That's generally how people come to us, how clients come to us. They think of it through the lens of divestment. The origin story of this is, as Nathan said, kind of socially responsible investing movement. A lot of that really came out of the apartheid divestment kind of group that culminated around university endowments, pension funds, things like that. These actors basically did not want to invest in practices or regions in which they disagreed with how they were operating. They didn't want their capital funding things like slavery or mistreatment of people, weapons, gambling, alcohol, tobacco, those type of things. To this day, this type of values-based investing is generally the most popular. And it's usually framed, as Nathan said, it can be a little bit confusing because you can see multiple different types of divestment products, and they will all mean very different things depending on what type of values lens they have. Is it a religious divestment lens? Is it more of a progressive lens? Is it a conservative one, or any other type of social or moral framework? So understanding the actual divestment lens of the product is very important. Generally, a really popular exclusion list that kind of spans the gambit of all the products are really things that you kind of see here, which are going to be like alcohol, tobacco, gambling, firearms, private prisons. Some companies that are generally heavily divested from are ones like Raytheon or Philip Morris, Chevron, companies that sometimes are not the best actors towards their communities, their employees, and their customers, and have hidden costs, societal costs to them that may not show up on a balance sheet. And so you want to divest from those because they may reap those costs one day. Moving on to kind of the second path that Nathan talked about is what we kind of call an enhanced methodology. It's really kind of the opposite way of viewing investing from divestment. It tends to be a very active type of management. You only own a handful or a few dozen stocks, a few, maybe 100 bonds or something like that, and you are attempting to maybe outperform due to capitalizing on societal trends, structural changes. You're looking to either reduce risks or enhance the performance of the portfolio by really latching onto those societal trends. And so that's really what you're attempting to do with this type of management. And it's a little bit newer, it's more thematic. It's more concentrated, it involves more risk. The goal of this type of management is, one of them can be renewable energy, for instance. As Nathan said, do you think the grid is going to be more powered by alternative energy or less in 50 years? And do we want to get ahead of that, or do we want to stay where we're at? Another really good example of this is responsible business practices, responsible businesses. A great example is Costco. Costco recently had a fantastic feature in the Wall Street Journal. I recommend looking it up on YouTube and seeing the coverage on them. Their CEO talks about how every single one of their employees, they don't view as just another cog. They view every single position as a career, and they treat their employees very well. And that leads to higher pay, better benefits, better treatment of their employees, and their turnover rate is the lowest amongst all physical retailers at only 9%, which is tremendously low for a retailer. And what does that mean? That means that Costco has lower costs of training new employees, lower switching costs. They lose less productivity by having to move to new employees. The largest line item, the largest expense of any company is employee salary and productivity. And so by minimizing their largest costs, they've done tremendously well. If you look at Costco stock over the last decade or longer compared to that of like Walmart or other chains, you'll see that they've done tremendously well by treating their customers, their communities, and their employees tremendously well. And so that is a really good kind of way that you can look at this. Another one is oil and gas phasing out. As Nathan said, are we going to be more into oil and gas in 50 years, or are we going to be less in oil and gas in 50 years? Do we want to divest and maybe put more of that into the renewable energy side? Overall, a way to look at this is if consumers have more access to information, and we already know that consumers like to align their purchasing decisions with their values. There's a reason why Patagonia exists. There's a reason why Whole Foods was started. People liked to align their purchasing decisions with their values. And so that drives profits when people choose those things, when there's more transparency, and that drives stock prices. It's really the crux of this type of methodology. Now we'll kind of talk about the third here. And the third is really distinct, impact investing. Impact investing is another category of investing that really focuses, as Nathan said, on altruism and material impact using your investment dollars. Generally entails giving up some sort of return or increasing risk or locking up funds for a prolonged period to generate a social or environmental return. And an example of something like this, a really good example that we kind of highlighted in one of our newsletters is microfinance loans. Microfinance loans are basically small amounts of dollars loaned to communities or to people that don't have access to traditional banking. A good example is in Ghana, there was a woman who was solo raising 3 daughters, and she had been trading in nut pastes in Ghana, and she had to travel miles to get her product that she harvested ground so that she could then go to the market and sell it. And she couldn't afford the grinding machine to do it herself, and thus she wasn't able to grow her business. And a $200 microfinance loan, that's something no bank is interested in. Loan was able to get that to them, a microfinance loan, an impact investment. And that allowed her to set up her business, repay the loan quickly, set up more, be able to purchase more of them, and she ended up putting her 3 children through college. And that's a really good example of how it creates jobs. These small loans can create societal impacts by generating jobs, and now her kids are going to college and may be able to do even higher value add jobs in the future and really develop that community. What a lot of people think about when they think about, or what they think in their mind when they have the idea of impact investing has to do with green infrastructure. Green infrastructure, a lot of people like to think about solar or wind turbines and investing in those endeavors, doing some direct investment in those areas. But a really growing kind of interesting area is something about grids. All of our grid was built to be one way. So the factory that makes the power ships the grid or ships the power through the grid to your house. Now we have solar panels and wind, and we need to be able to send energy back. A lot of these are funded through government contracts that need private dollars to also come in to actually be able to speed this up because there's not enough in the government space. And so that allows that type of investment allows us to actually utilize the green investment that's being done to create these wind farms, create these solar factories. And it's a really interesting part of impact investing. Another is social investing. A good example is Montessori schools during COVID. A lot of these schools are private and they support vulnerable communities. And a lot of these schools kind of dried up in funding during COVID when they were not having active students in the classroom. And so a lot of these impact funds could go and give them bridge loans so they can continue to exist and serve underserved children post-COVID. Next, now that you've kind of gotten the definition and understood about some of the methodologies or ways that you can invest your money, there's really another story here, another side of the coin. And no matter which path you select, even if it's multiple or an amalgamation, you also get the opportunity to engage with the companies you own. You are an owner when you invest. So no matter what path you select, you are an owner, and that gives you certain rights, actionable items that you can take and vote. And it really, this other side of engagement brings your kind of some of these investing themes to life. So if you really want to make a difference in the world using your capital, this is the other side of the coin that's very important to that. And we talk about kind of what engagement means and what your rights are as a shareholder here. So when you own a stock, as I said, you are an owner, you have a voice in how the company is ran. Some of the things that you get to do is vote for the leadership, the board members, what type of people are going to sit on those boards and make the decisions on how those companies are ran. You get to decide what corporate actions are going to be financed or undertaken in any given year. You can decide to pass or not pass sustainability or carbon emission mandates on that company. You can educate or file new propositions with the leadership. These are all things that every single one of us, if you own any stock, even if it's inside of a mutual fund, inside of your 401k, you have that right to do. A really good example is when Walmart decided to stop selling firearms. It actually was a very grassroots movement. It started with protests and advocacy groups, very similar to Third Act, and it kind of got through to shareholders, and shareholders proposed, hey, we don't want to participate in this business practice anymore. And then it was voted on by the board of directors and the shareholders to get rid of that practice, and they no longer participate in that. So it's a really how you can make some material change through the power of your capital. And it's a really important piece. So next is what is kind of like in your investment? Is your fund that you own, no matter which one it is it engaged or is it not? The task of voting on every single proxy resolution and being educated on every single one is very daunting. For instance, a single company can have hundreds of resolutions in any given year, and you can own hundreds of companies. We're talking about thousands of votes a year, and to be educated on every single one of those, there's no individual that really does this. And so that is actually done by the fund. As Nathan said, there's different layers here. You have the broker or the financial advisor, but the actual fund that you select, that name, is it a Vanguard fund? Is it a Fidelity fund? What is it? They are the ones who decide on whether they're going to engage on these or whether they're not going to. And there's entire teams dedicated to this at each one of these fund companies. And so it's really important that not only the underlying investments are aligned, if you care about these things, but your fund that you're selecting is also engaged on a corporate level and voting on behalf of your values. Many companies many fund companies such as Vanguard, State Street, and BlackRock, used to vote or attempt to vote on these things, and they largely have stopped due to political backlash and things like that. A lot of these traditional companies jumped into this realm when it was a hot kind of thing to do, the next cool part of finance, where it was attracting a lot of finance dollars. They said, okay, we're offering these funds and we're going to vote on behalf of these things. And then the second any political backlash came, they really dropped it and said it's not worth the effort. So they were really putting profit above the actual materiality of voting these things. They didn't maybe necessarily care in the beginning, is what it seems like. And so there are also funds that continue to engage to this day, but most of the large providers don't.
So I'll just add to that this is another layer of analysis that we do when we look at the funds that we use. Are they engaging or are they not engaging as an active shareholder in the companies that they own? So you have funds out there that are maybe called green or ESG funds, have those labels, sustainability, but maybe they're not voting their proxies. And as Brandon mentioned, Vanguard is a great example of that. So Vanguard is a huge company. By some measures, Vanguard controls 20% of every dollar that's invested in the United States. 20%. So that means that they own 20% of almost every company that exists, that is a public company in the US, and they also own companies overseas. They're a huge money manager. So if you have a Vanguard fund in your IRA or your 401k, you're not voting those proxies. You've handed that responsibility over to Vanguard. Well, guess what? Vanguard's not interested in voting their proxies. It was too politically problematic. Vanguard as a company chooses not to do that. And then at the fund layer, they may have a fund that screens out energy companies, but then other companies that may not be acting the way that we would want them to, they're not voting their proxies. They're essentially giving that voice away to the other 80% of shareholders that will drive the corporate resolutions of those companies. And then when you think about the largest fund managers in the United States, it's Vanguard, it's BlackRock, it's Fidelity, it's State Street, it's JP Morgan. They probably control 50, 60, 70% of all the funds, of all the money that's invested in the country. And they're either not voting their proxies at all, most of them are not, but some of them are voting on resolutions and board members. But we want to make sure that our voice is heard, our voice is magnified. And in this realm, the best way to do that is finding companies that are aligned with our values and are engaged shareholders in the companies that they own. So as you can imagine, there's so much more to this story. This is just the first chapter of starting an investment journey. And so what would be the next steps? Well, we are already thinking about how do we follow up this presentation with the next chapter. But if you're going out to start this journey on your own, the first thing to do is to start assessing the tangible pros and cons of values investing. As we said, are you an impact investor, an enhance investor, a divest investor? So thinking about yourself, identifying investments that are authentic. And again, the research that you will do will probably give you some answers to make sure that those investments are authentic. There's US SIF, the United States Sustainable Investment Forum, which has a list of and identifies a list of aligned funds. There's As You Sow that Michael talks about a lot in his presentations. Their focus is fossil fuels. Morningstar recently bought a company called Sustainalytics. And so you can take the name of a fund or its ticker symbol, just plug it into Google. Its Morningstar page will probably be one of the first things that comes up for you. And because they bought Sustainalytics, now every single fund has a globe score. Is it 1 globe? Is it 5 globes? And that starts to talk about the sustainability of an individual fund. And again, that information is public and in large part free. So that's another path to start your research. And then finally, when you think, if you think that you're looking for support in going down this path, you're looking for you're looking for advisors that are front and center on talking about either on their website or perhaps in an initial meeting that, yes, this is something that I'm familiar with, that I've embraced. But now you can also start talking to them about, well, how do you build a portfolio? Do you have a specific path that you favor between divestment, enhancement, impact? What are the pros and cons of those different strategies? I understand that with an altruistic purpose, I might be giving up some returns. Does that still align with my financial goals if I'm giving up, or my charitable goals? Does that still align with my financial plan? So those are some steps to think about to get started. And I think we're at the almost to 7:45. It gives us an opportunity for some Q&A. What I would also just add here is that this presentation came about from a newsletter that we shared with our clients to say, hey, you might not have thought about it in this way, but here's a way to think about it. It's two-page newsletter. And so if you want to recapture what we talked about here today, and you don't want to go through the entire presentation again, email me directly, and I'm happy to share that newsletter with you. It has all this information that you just heard. And also, Michael, I think we're also going to post this presentation on Third Act. Is that right?
Right, Nathan. It'll be on the thirdact.org, the main website, and it'll be on the resource page for climate finance.
Great. Thank you so much, everyone. And so, Michael, take us home, and let's see what questions we have.
Well, let's take and look at each other here. First of all, I like that word authentic that you use, especially when we're talking about investments. It's right in there with bona fide. When we talk about the banks, right, we say about how if you want to leave those big Wall Street banks that exist for the purposes of providing complex financial services for Wall Street companies, leave them and go anywhere else. And of course, we show folks how to find those nice community banks and credit unions. And the same thing with the insurance companies. Leave those big insurance companies and we go out there and we find those regional mutuals that are not insuring fossil fuel projects, that are not investing in fossil fuel projects. So here we have these asset managers. And I'm going back to this authentic, bona fide. For a long time, Nathan, we thought that we didn't have too many choices out there. There was BlackRock and Vanguard, and then there was State Street, and there was the same bunch, the same Wall Street bunch. But actually, there are a lot of good asset managers that are doing this impact investing, and we need to have our financial advisors show us how to get there. So I think I'd like to lead off to the first question. When we're out there looking to align our money with our values and our financial advisors are not hooking us up with these good asset managers, what is someone's to do? Again, you printed my motto there. Leave them, go someplace else. How do we get that done?
I think the process of finding a financial advisor is a very personal one. You obviously want to be understood by that person. So if they are misaligned with something as basic as your values and are not seeing you for the whole person that you are, there are other paths that you can take. How do people traditionally find a financial advisor? It's through friends, it's through other professionals that they value, or just people in their social groups or their other organizations where they volunteer or where they contribute to their social circles of people that are values aligned. They may have people that they can recommend. There's also several websites that have attempted to start creating directories of financial advisors that are aligned. Valuesadvisor.com, I think their .com is one. Green America is another, although I think it's a little tough to find right now on their website. Those are the first two that come to mind.
Well, I see there are quite a few folks from Third Act that are actively involved in their climate finance team, and I know some of them are working to help their third actors find those financial advisors so they can line up. But why don't we, instead of using the chat, just use the raised hand? So if you have a question for LONGWAVE, pop your hand up and let's hear your question. Tom.
guess I'm in that category you just mentioned. But
You are very much in that category.
my question is not quite about that, actually. It's about a very related piece of the activism that we do. Here in Massachusetts, we're doing a lot of work on state pensions. And because the state pension fund is not nearly as green as it could be, and it's $100 billion. And I feel like we run into really what I want to ask you about is the community of financial advisors and how they look at this stuff, because it would apply to any of the personal pieces, but it also applies to the work we do politically. I feel like the people in the legislature, as an example, assume that that there's that trade-off. If you're going to do something altruistic, you're going to compromise your returns. And I've heard from other states who are working on pensions that they hear that from the unions. Here, the teachers union, which is the biggest, understands that that's not the right way to look at it. But most of the research that I see coming out lately makes it pretty clear that although there might be some specific instances where doing climate-friendly investing compromises returns, that actually very often the opposite is true, and that doing climate-friendly investing is more likely to improve your returns. And my question is, how well is that understood among financial advisors and in the financial community? Because it seems like the general public still thinks there's a big trade-off there, but the research is saying there isn't. And is that because there really is, there really isn't? Are financial advisors aware of this? Are they communicating this to clients, etc.? I hope that was a clear enough question.
So Tom, is the question that, why is there a disconnect
My
between,
question is really whether the world of financial advice understands what I think I'm seeing in the research, which says climate-friendly investing is generally as good as or better for your returns.
yeah, do you want to?
Yeah,
answer?
there's a couple different layers to it. So if you're talking about specifically climate, how a lot of people propose that it is better for your investments, they will use indexes like the MSCI ESG index, and that is kind of a climate-friendly index, and it has done better than the traditional one. And a lot of that is the result of climate-friendly funds tend to underweight oil and gas companies, and oil and gas companies have underperformed, and they've overweighted technology because that has a low carbon output. It has very little intensive assets. And so those have done better. So climate related funds have done better for that respect because they've overweighted technology, underweighted intensive carbon assets like oil and gas. And that's just how the market has done. There's been times of reversal, and there's been times of, and that kind of goes to the enhanced methodology that we were talking about. Do we want to get ahead of societal trends where we think oil and gas is going to be a smaller industry in the future and green technology is so the people that are saying this is better for performance, they're very much in the enhance kind of path, and they have been proven mostly right for the last few decades. Technology has had a tremendous run, and that tends to be overweighted in these funds.
One more thing I would add is some of this is old news, where it used to be that if you wanted to invest in a sustainable way, that was very laborious and time-consuming. And laborious and time-consuming generally means more expensive, and it was. So you can have a Vanguard fund that had a very low cost to invest in, and then you might have a green fund that had a very high cost to invest because of all the research that needed to be done. Well, that cost differential has really come down tremendously. There's a lot of things out there where, let's say your approach is divestment. A fund that focuses on divestment is going to have roughly 90% of the companies of a traditional fund. And so, the costs are now very, very low. You're still very diversified. And because of what Brandon just talked about, at least for the last 5 years, as you said, Tom, you would have done as well and maybe even slightly better if you took this approach. So thank you, Tom. I hope that answers your question. We have another hand up. Thank you.
Sally put a question in the chat, but she also has her hand up. Is it the same question, Sally? We'll just let you ask it.
Yeah, basically I have a really great friendly financial advisor at Morgan. I had another person look at what my investments were. He showed me the green garbage that I was getting from Morgan. So I talked to Jim about that, and he said, well, gee, you know, there's nothing I can do about that. I just stick you in that fund a certain percentage. This is what these specialty guys do. You know, that's all I could say. So I basically understand that they have greenwashed tons of stuff at Morgan, but I am frightened to leave Morgan because I don't trust my own judgment in finding a financial person. So can you guys respond to that?
So
I mean, what are the assurances do you have with an individual financial advisor? Like when I'm with Morgan, I know that I can't wake up and find out that somebody's a Bernie Madoff, right? But with my own financial advisor, I can.
Yeah, absolutely. That's a great question, Sally. Thank you so much. So a couple of things to think about and ask about is number one is the advisor that you're interviewing, are they a fiduciary?
Know that, right?
So there's that.
Yeah.
And the other question to ask them is, are they independent? A advisor that works for a big financial institution like Morgan Stanley is not necessarily independent, but you have a relationship with them. You have a long-standing relationship with them, so there's trust. And also, Morgan Stanley is a household brand. Not that they never get in trouble. They certainly do. You know, every financial institution has rogue people that can, you know, go off and do their own thing. So that's not necessarily a guarantee, but it's a place to start. And again, I think asking around to see what friends, family, colleagues have done, and if they have 10, 20, 30-year relationships with people and are in a group, then that's another place to start. The other thing that I would point
How
out,
were the people connected with him, though?
I'm sorry?
So were the people connected with him. So that's not an assuring answer.
Yeah. So another way that we talk about Bernie Madoff is when you think about having a financial advisor, there's really three different functions. There's who is managing the money, who is generating the statements, and who is holding the money. And so when it came to Bernie Madoff, he was actually performing all three functions. He was the advisor, he was generating the statements, and essentially he was holding the money. He was doing all the custodial responsibilities. That was really incredibly unusual then, and certainly a red flag that a lot of people chose to avoid, chose not to avoid. But now I think that's another lens to look at if you're looking to find somebody new does that separation of roles actually exist?
Yeah, really, you need to identify the advisor actually doesn't hold your assets. It is the third-party custodian. They're like your bank vault, and the bank vault is not your advisor. And as Nathan said, in the case of Bernie Madoff, he was your vault and he was the advisor. So if they're separated entities, the advisor doesn't have the same opportunities.
And what was the third one? There's the advisor, there's the third party custodial that holds it. But you said
the custodian.
And the statements, who's generating the statements?
Yeah.
who makes the statements?
Yeah. And so most independent advisors, I would think pretty much all use a third-party custodian. So that could be Fidelity, that could be Schwab, that could be BNY Mellon. So those companies exist simply just to provide custodial services to advisors that have chosen to be independent, not be restricted to whatever is limited at a big bank.
And they have insurances as well, custodians on
And
their.
then the third one there that you mentioned is who's actually managing the assets. That's your third one.
Well, isn't the advisor the one that's managing the assets?
Yes,
No.
they're collaborating with you as the client to select which investments to invest to add.
So the advisor is not the manager, or is the manager?
The advisor is the manager. Then
Okay,
there's a third party generating the statements, and then there's the custodian.
thank you.
Kelly, you have a question.
It's real quick. You very articulately defined 3 pathways there. Can someone pursue all 3 pathways?
Yes, that you definitely can. And at LongWave, we attempt to accomplish many of those pathways within portfolios. Your capacity to do multiple really depends on the construction of your portfolio. But yes, of course, in a lot of times they sometimes come hand in hand in the same investment. For instance, if you are attempting to enhance, you also have to exclude because you only own a few names. You may only own a few dozen names. And so you're not only selecting what to invest in, but what not to select in. So there can be kind of an amalgamation of these methodologies and individual portfolios. And we like to think that there's actually an intelligent way to combine these to lower the costs to the client while also maximizing their potential for material connection to the values. And we have a kind of our own way of mixing them that we think is kind of really convincing. But yes, of course, we would say most portfolios take at least 2 of these approaches.
In many of the workshops that we do, we'll actually identify some of those asset managers that are out there doing some very aggressive advocacy with the climate. Ones that come to mind, of course, are Trillium and of course, Green Century's out there. They use Trillium and a few others. Could you name 1 or 2 more of the asset managers out there that are really active in advancing green causes?
Yeah, I think an important caveat with asset managers is that they are not advisors, so they don't tell you how to construct a holistic portfolio or anything. They just provide a product. An advisor would be like the curator, and then what's on the shelf is going to be the products. And so we curate products that we find highly convincing, some that we partnered with in the past and that we continue to, and ones that we like quite a bit. Calvert is kind of one of them. They were really a pioneer in the space. They offered some of the very first ESG integrated funds. Boston Trust actually was an advisor on some of those very first funds, and they continue to exist to this day. Those are 2 storied companies that have been through the highs and lows and never waned really, and done a terrific job for their investors from maybe our point of view. So those are a couple names that I'd like to shout out for sure. Boston Trust Walden, that's the full name.
So we've gone just past the top of the hour, and certainly there's no automatic off button here. Tom did have one more question if nobody else had a question before him. Take it, Tom.
So this is a question that has come up for me personally and also in the political work, which is about the effectiveness of the engagement strategies. And you just spoke to that a little bit, but personally, in my own investments, it goes back to exactly what you already said, which is the amount of work I would need to do to engage myself is just it's a super high workload. But in the political realm, we see a lot of people pushing engagement and wanting to use engagement as kind of how they're going to address climate and environmental concerns. And I will admit to not having done nearly as much research as I should to probably make this statement, but what it looks like from the outside is it looks like greenwashing. It looks like they're saying we are engaging, we are going and supporting all these resolutions and supporting all these director candidates, but a lot of them don't win. And so the actual impact of that engagement often looks very small. And I guess my question is engagement, can engagement be effective? And how do you look at somebody who's using it and say, are they doing it effectively or not?
Well,
Because like the pension fund in Massachusetts does this. They have a sustainability committee. They tout all their engagement work, but I can't see that they actually got anybody to do anything.
yeah. So I can't answer to that particular organization, but the
That's
funds
okay.
that we mentioned, I think they as far as I can think of the ones we mentioned, they all publish annual and in some cases quarterly impact reports for their fund lineup. And so you can go into those and they will tell you all the proxies they voted on, what's had an effect, what hasn't had an effect, and some of the stories where they've been successful, some stories where they haven't been successful, and you can actually see the actual effect that they're having. It's measured, it's published, and it's reported.
Yeah. Yeah, and a lot of these fund companies form coalitions because it's really the power in the amount of capital, right? So the more money that is managed in this way and voted in this way, they have a larger voice. So a company like Calvert and Boston Trust and Green Century, they'll all get together and vote the same way for similar shares that they own in order to move the need a little bit further. And you're kind of right when it comes to the large cap space. We talk about this with our clients pretty often. Engagement in the large, with large companies can be more difficult because these companies are trillions of dollars. Imagine how much money these asset managers need to have in ownership. Even Vanguard doesn't have enough money invested in these companies in order to make material change themselves. And so they need to form coalitions and make change. And a lot of that impact and engagement work where you see some really, really heavy hitting results is going to be with smaller companies and mid-sized companies. That's where a lot of the really good stories come out of. But you're right, with the large companies, with these multi-trillion-dollar companies, it's very hard to move the needle with them just because of their size.
Thank you.
Thanks.
Well, I want to thank you very much, LONGWAVE Financial, all of you. And we look forward to doing some more informational workshops in the future on some of the other topics. And thank all the participants that came in today, particularly many of you are actively involved in helping other third actors and other people in green faith to align their money with their values. So keep up the good work. And
Thank you, Michael.
see you again soon.
Thank you.
Thank you. Thank
Happy
Earth Day,
you.
everybody.
Thank you.
Thank you.